please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, welcome back. So 40 points on the Nifty right now, 10,470 odd is where we are at. So it's exactly where it was at 11 when we began the show. Rupa and Company reported earnings. The stock is up about 2.5%. It's come off the day high. It gapped up to about being up 4. So it's lost from the highs. But the numbers are pretty good. Revenues are up 10% in the quarter. They come in at about 420 crores. Margins have expanded, actually big time. Operating profits are up, very large percentage. So let's get talking to the management to break these numbers down. Ramesh Agarwal, whole-time director of the company, is with us on the phone line. Mr. Agarwal, thank you for your time. Good morning. Could you
good morning to all of you.
Tell us the story behind the numbers, really, business-wise? I mean, is there are these big increases, percentage increases, all like to like? Is there anything else we need to account for here in these numbers?
No, actually, for us, the previous year was not so good as what we expected. Throughout the year, we were not in the growth mode. But the last quarter, somehow we managed to increase our sales. But the thing is that we are not happy with the results. So this year, we hope to do a much better job.
Okay. Mr. Agarwal, you've shown a good margin trajectory, however. It's improved.
Yeah, margins have increased for different reasons because last year the interest cost has come down. The internal efficiency of the company has gone up in ways of internal cost controls and other things. And GST also had a role to play here because whatever advertisement spend we were doing, the service tax, we are getting a refund.
So what are you expecting in terms of margins in FY19? Are you expecting it to at least improve on a consistent quarterly basis?
Yeah, it should.
And the range?
Overall, throughout the year, it should grow by 1%. I think.
You're saying FY19 margins should be at least 100 basis points better than FY18?
Yes, hopefully, yes.
And in terms of because you began by saying we're not happy with Q4, FY19 will be a lot better. How much better? I mean, if you have some numbers in mind.
See, this year the volume growth had been around 7-8%, as you said. The value growth and the volume growth has almost been flat.
That is FY18, yeah.
Yeah. So for the next year, for this current year, we hope to do a volume growth of around 7-8% and value growth of around 15%.
How are you going to achieve that?
See, Fruit of the Loom should be the leader in that. And Fruit of the Loom, wherever we have launched, it has shown a good response. And this year, the target for Fruit of the Loom is around 100 crores. So if we can achieve that, then this, what I'm saying would be true.
100
all
crores,
our other
100 crores
brands
in
are
sales.
also doing very good.
100 crores in sales from Fruit of the Loom in FY19.
Yes.
What did you do this year in it?
Sorry?
What were
this year was around 25 crores.
Oh.
Okay. And what about from Fruit of the Loom, margins? What did you do this year? What can you do next year? Profits, etc.?
Fruit of the Loom this year is broken even. So you cannot expect margins in this year.
Yeah, okay.
There was a loss, in fact, in this year.
Sure.
But in the coming next 2 years, we will show a good profit in Fruit of the Loom because the turnover will increase and all the other expenses would be margined out.
Have you built up distribution for Fruit of the Loom adequately? I mean,
yes, and it's growing. See, you cannot say that you have done everything, but in most of the areas, the distribution has been set, and new areas are also growing, and in the existing areas also, the network is growing. So it was launched in December, so you have to give some time. So during this year, if you want to achieve 100 crore, we have to also increase the distribution at par.
Will you look at more such tie-ups in FY19 and what might be the inorganic initiatives except for any other tie-ups?
See, the inorganic would be only through, we would be more interested in an activewear brand if we can get one.
Okay.
Because we see a good future there.
Are you already in talks? Where do things stand?
No, nothing serious as yet. No.
Just to go back to fruit of the loom, so you're saying, I mean, in terms of the product range, has everything been launched, or are you in the process of launching more product under the brand?
The product is a continuous process. No? You have to keep on adding products. So basic or a good range has been launched, but you cannot say that it's a complete range. It will keep on increasing.
Okay. You know, the flashes which are on at the bottom of the screen, I think we just need to make one correction. Volume growth will be, I think what Mr. Agarwal said is 7 to 8%. Sales growth will be 15%. I think we are saying volume growth 15%. So we'll make that correction. Okay, so you're saying that product introductions will keep on happening, right? Under the brand, under the Fruit of the Loom brand.
Under Fruit of the Loom and under the Rupa brand also, means our basic brands also. All the brands have shown a good performance in the last year. Good in the sense there, I mean, all the brands were on the growth trajectory. So this year, though we are not happy, this year it should be much better. So the growth, what I'm saying, volume growth of 15%, value growth of 15% will come, will be a cumulative effort of all the brands.
Okay. Fair enough. Will you have to advertise heavily for this? I mean, you know, from the time that you launched Fruit of the Loom, we saw heavy advertisements going up in prime locations, etc. Will what you spend on ads, as a percentage of sales,
our
go
ad
up substantially?
spend is around 7 to 8%, and we'll cap it to that. We cannot increase the ad expense. Maybe brand-wise will keep on increasing or decreasing, but the overall effect on the company would be not more than 7 to 8%.
Back to focusing on what the market itself can do, 10,467, 468 is where we are on the Nifty. Prakash Gaba is with us in our studios. Prakash, thanks for being here. Your sense in terms of whether finally we've in a way bottomed out for now in this correction?
Well, I would say that basically, Prashant, the structure basic is still weak.
Okay.
Yesterday's low shouldn't have been broken. That has broken yesterday. So a day for yesterday's low. Having said that, which basically means that it can still slide on. Yesterday we had a target of 10,417. That was achieved like a target. It was good. Now, as long as that low holds, and if it breaks today, tomorrow or day after, we could go in for a fresh bout of selling. So far, purely because of FNO expiry, for the options expiry on bank, we are seeing some kind of a short covering. So for today, purely for intraday purposes, looks like it has bottomed out. We could see an up move today. So any dips today could be bought into. Where does it go from here? The chances are we can climb up to 10,480 to 10,520 on the Nifty is a possibility.
Okay. Prakash, what would your stocks be?
I have two stocks, and both on the long side. I'll go with Aurobindo Pharma. That looks good. Seen a good correction. We could see a bounce from here. That could take it to around 595 zones, stop below 575. Today, the pharma pack is showing some kind of activity here. I also like Axis Bank here. Looks like a good, again, a good down move for around 7 or 8 trading sessions, a good base formation here. We could see a chance, maybe around 535 zones. You can climb up to there, stop below 522.
Okay, well, we have a couple of Twitter queries for you, Prakash. The first one is from Ashish, 390 shares of Rain Industries at 359. Wants to know whether to hold or sell.
I think he's bought it and then cracked from there. When I look at the Rain Industries chart, it's gone up from 40 rupees to 480 rupees. Such a parabolic rise in just a year, year and a half. This kind of move normally is suggestive that we would see some correction. What we have seen is more of an exhaustion pattern here. Rain Industry is sitting on a loss, and the more you hold, the more you lose. The best is to exit. Sometimes you have to suffer and accept a loss, but looks like it's heading down.
Prakash, thanks very much. I appreciate you joining in, and good speaking with you for that perspective. We take a very quick break here, and we come back for...
Samir of MK Global Financial Services joins in to discuss the fundamentals of the market. Sindhu, hi. Thank you very much for joining in. Wanted to start by asking you about what you think the likely range for the Nifty is now. Just a couple of weeks ago, it was around 10,000, up to around 10,700, but it seems to have moved lower now.
It's tough to talk about the range of Nifty, but yes, I mean, the kind of macro we are having at the moment, there can be a cut in Nifty, anything between plus and minus 5%. So Nifty will be range bound. At the same time, I don't envisage a serious downward movement in Nifty, but very tough to talk of a precise number as of this moment.
So what is top of the mind for investors that you speak with, Sindhu, right now?
Now, top of the mind is, of course, macro and the rise of oil, which was never envisaged. Just 1 year back, people were saying that oil is getting disrupted. There will be a rise of other renewables, and oil might settle down something between 40 to 50. And lo and behold, oil is at $80. So this has spooked a certain set of investors. Of course, US shale oil is there and all those things are there. But this oil has brought the focus back on macro, which was not there for 1.5 years as such.
Is there a fear that it could probably worsen as we go down the year, and the market is probably not factoring that in, that maybe the currency could go to 70, crude could move higher, twin deficits could get impacted from here on, RBI could hike rates?
Of course, you said it better than me. So there is a fear that we can revisit 2013. I hope it does not play out. But yes, these are things which are being talked at the moment among the investing community. At the same time, the redeeming features is that results have been by and large very reassuring. So it is a balance which is playing out. Of course, the multiples had swollen a lot in mid-cap companies. They are retesting reality once again, so that's a welcome point. But at the moment, macro seems to be weighing heavy on the market levels.
You know, so oil is a variable. No one knows where this is going to be a year from 6 months from now, a year from now, right? You know, and it's been creeping up steadily, so it's not happened overnight. My question is, you know, generally markets are forward-looking beasts. I mean, they look at what earnings, not what earnings are now, but what earnings can be. I mean, it's been so evident for the last couple of years. We've been that way, expecting higher growth, getting disappointed, and expecting again the next year will be a lot better. So why are people getting resigned to you know, a sense of despondency with? Of course, I mean, oil getting to this level is not high for the macros. But no one has any. It's one of the most unpredictable variables, if I can call it that. So is there a buyer fatigue as well, and it's getting blamed onto some of these macro factors?
So it's not that. I mean, despondency is a strong word. I think that the word which can describe at the moment the sentiment is caution. So, I mean, market at 34,000 is not a despondent market anyway. But look at the rise of markets right from demonetizing. It has been a very smart rise. So it is a sense of caution. And 2018 was supposed to be a stock pickers market. This is exactly playing out the way it was expected to be. Larger, broader market moves are not there, but we are not headed for a crash. So it's a cautious market, which actually is a stock pickers market and a fund managers market where you can actually play out on great companies, overlook the bad companies. You are not forced to buy into companies which are fundamentally not as good, and still you have to buy it because there is a portfolio perspective. Coming back to your first point that markets are a forward-looking mechanism, they are definitely a forward-looking mechanism, but forward-looking mechanism foresaw that oil will be $80. Now, since the human mind is such that you have to prolong the recent events, so the market is now, perhaps a segment of market is fearing that it can escalate further. So forward-looking mechanism, recency playing out is what is leading to a sense of caution. And I once again repeat, you might be furious at me that it's not a despondent market.
Well, there is despondency definitely in the mid-cap, Sindhu. If you've seen the kind of correction that you have, is that an opportunity as well? Or do you think that people need to exit, say, highly leveraged stocks or maybe a few of the volatile ones?
So first of all, mid-caps are also standalone businesses. So rather than drawing this line in the sand that here is mid-cap and here is large cap, my request to all kinds of investors, be it institutional or retail, will be to look at standalone businesses. If there is no comfort in business, be it mid-cap or large cap, please exit. But drawing a line on market capitalization rather than on a standalone business quality is not the right thing. So look at the business. If one finds it expensive, be it mid cap or large cap, that's the call one needs to take. And these are the days, these are the levels, these are the times that which are precisely built to take a call for this kind of a call.
Sindhu, we were told that you cannot speak about specific stocks, so can't ask you for what you're pushing to clients, etc. But without naming names, can you give us some sense? Is it possible to do that? Where one should look for opportunities? Yeah.
Okay, so one first thing is that, I mean, just look around at your home, what is coming in and going out. This is the most macro clue. essentially, I'm hinting at individual consumption.
Okay, sure.
Essentially, I'm hinting at individual consumption. Just look around. There are many sectors, there are many companies which are playing on this opportunity. Even to put it technically or to put the right jargon, look at the India opportunity. That's a great opportunity. Just think at the levels at what India was in 1991 when the reforms started. The total GDP of India was less than 500 billion. Today we are sitting on a 2.5 trillion economy, which prospectively in 10 years might be 4 or 5 trillion economy. So it's investing, as Warren Buffett has said, that it's simple but not easy. So look around, you will get many opportunities.
Okay, all right, Sindhu, on that optimistic note, we're going to wrap up the conversation. Thanks very much for joining in and talking to us. So that's the view coming in from MK. Just want to point out one stock, Sun Pharma, which is powering ahead of its numbers tomorrow. So that stock is at the high point of the day, up around 3.6%. Yes, in context of the kind of 18 to 20% fall that we've seen on a year-to-date basis for the stock, a 3.5% rise is not much, but it's coming ahead of its numbers tomorrow. So maybe the street is a bit more up. Well, Tata Motors reported what was a weak set of earnings for the fourth quarter. However, Elara Capital has upgraded its rating for the company to accumulate from reduce as earlier. They believe that the risk reward is now favorable from current levels. Jay Kale of Elara Capital joins in to discuss this. Jay, hi, thank you very much for joining in. So what's your rationale for the upgrade considering the kind of underperformance that we're seeing for Tata Motors?
Yeah, I think Tata Motors has underperformed for the last 1.5 years, mainly because of the concerns of JLR. So JLR EBITDA also came in marginally below our estimates, the adjusted EBITDA. However, going forward, I think the valuation comfort is extremely favorable. JLR has got derated in terms of valuation at approximately 50% in the last 1 year in our view. And further, I think volume growth needs to be keenly watched at JLR. Standalone has been impressive in terms of the free cash flow. However, margins were below estimates. But I think with the restructuring of costs at standalone, things should revive going forward for standalone segment as well. So I think overall the risk reward seems extremely favorable, and hence we've upgraded Tata Motors from reduce earlier to accumulate.
Jay, I mean, if you read what global banks and brokerages, etc., who track not just Indian, I mean JLR, the JLR business, but also other global luxury OEMs, there is a sense of caution which is now creeping in, and I guess the JLR business will also get impacted. I mean, it competes in that same price segment. Your thoughts there?
Yeah, I think those concerns were pretty much there. I think JLR volume growth, there were concerns since quite some time. If you see FY18 volume growth has softened to around 3% odd. So the concerns were mainly then, that's the reason that we were reduced earlier. I think the stock price has got, is factoring in extreme pessimism. And while we remain cautious on the volume growth of JLR, but even in a bear case scenario, we see limited downside from current levels. But yes, on your volume growth side, on JLR, we will remain watchful on the volume growth.
And what about the JLR margins? What is your expectation for FY19, and do you think they've bottomed out?
Right, so we have, kind of our EBIT margins, including the China JV, are around 4.38% to 5.3% in 1920. That's largely in line with what the management has guided in the medium term. The forex losses evaporating in the next 2-3 years will definitely cushion margins. However, the mix, we'll be watchful of the mix. So we've taken all those factors into consideration and believe that management would be at least be able to meet its 4 to 7% guidance in the medium term, which earlier was for adjusted for the PDC was around 8 to 10%. That remains for the long term, but I think the medium term margins will be under pressure at 4 to 5%.
And quickly, your picks within the auto space, including Tata Motors, what's your pecking order?
So Maruti would definitely be one of our picks. Volume growth continues to remain strong over there, and the order backlog is also pretty strong. Baleno Brezza continue to do well along with the new Swift. So Maruti is over there. Motherson is another play that we like, and the tire stocks like Apollo Tyres and MRF is something that we are betting on.
All right, Jay, thanks very much. Appreciate you joining in with those thoughts and that perspective on Tata Motors and, of course, the rest of the auto pack as well. 35 points now on the Nifty is where we are at. And maybe we can just quickly look at the Bank Nifty, mid-cap and small-cap indices as well. So that's the Nifty. Bank Nifty on your screen. It's turned down. Actually, most indices have turned down a little bit in the last, 20-25 minutes. And we'd have the mid-cap and small-cap indices up for you as well as there's flat, nothing, 0.5% lower. The small-cap index is absolutely flat as well. Okay, for those of you who've been thinking of whether public sector banks are looking good, I mean, they've had a great week, definitely. But if you've been wondering whether to get in or not, here's some opinion watches coming in from Manish Sonthalia. He believes that you've got to be a brave heart to get into PSU banks currently. Manish Sonthalia from Motilal Oswal AMC. Listen in.
On overall basis, the Q4 quarterly results this far has been pretty decent. Apart from big misses here and there, I think earnings growth has been good. And let's hope that monsoons are good and the next 2 quarters would be a build-up on the earnings going forward.